This conference will now be recorded.
Great. If you're on a phone, I don't know what you're going to see. If you're on a computer, you should be able to see. Hold on, where was this? My slideshow here. Share screen. Got it. So if you change the layout, I think you can do a larger one or pin the state of the economy to the screen. There are going to be quite a few slides, so it would be helpful if you can see it. If not, we're going to be talking through it. One of you lovely gentlemen, if for some reason my slides don't match up or I stop talking, please interrupt me because I'm going to be looking at the slideshow. So anyway, I'm going to be starting us off. I'm going to be covering a little bit of the macro history of the economy. So what is happening in the national economy, things with inflation, as well as a bunch of other things, and then also diving into real estate. So my section will be a little bit longer because I have two sections. We were supposed to have a financial advisor, but we had three of them cancel on us. So here we are. So I'm jumping into it. So first thing I want to talk about today is inflation. So we have all heard inflation get talked about in the news. This is a common hot button topic. Steven's going to talk a little bit more about it as well and how inflation affects mortgage rates. But what I'm going to do is I'm going to talk about what does inflation affect on a macro scale. So macro meaning like a large scale view of what's happening in the American economy and really the world economy. So there are two measures of inflation that are looked at, as well as some other things like the PCE and a few other things, but the CPI is the inflation measurements. So back in 2020, 2021, the number that was looked at was the core CPI. That was what was always in the news, was here's where we're at on core CPI. That got up to about 7% in the peak, and it has since dropped to 3.2. So the core CPI excludes food and energy costs because food and energy are very volatile. So you can have, eggs go up 180% in a couple of weeks because of bird flu. Those things are removed from core CPI. Same with gasoline, fuel for your home, things like that. So anything fuel or energy related is removed from core CPI. So it's meant to be a lower adjusted rate as opposed to a true CPI, which includes food and energy costs. So the media was talking a lot about core CPI when it was 7%, and when CPI was 9%. We didn't really talk about the 9% number in the media. Now the conversation has shifted, and they're talking about the CPI because that number is lower. So data just came out yesterday. CPI has gone back up to 3.0%, and core CPI has gone up to 3.3%. So we saw a small uptick in inflation again. So what is driving inflation? That's a great question. Thank you for asking. We'll get into that in just a second. The other thing that the Fed is looking at is unemployment. So the baseline goal is less than 6%. At 4%, anyone that really wants a job, it's maybe not going to be the job they want, but anyone that wants a job generally can get a job in a matter of months. When you get to 6%, it's a little bit harder. The more skilled workers are going to be employed, and some other like maybe more manual labor jobs or things like that may have a harder time finding employment when we get to like 6 or 8%. So looking at the historical trends, we have been all over the place. Obviously, 2020, we saw a huge jump in unemployment. Same with 2021. It was still a big decrease, but a lot of people were still laid off during that time. The last time we saw really high unemployment was right after the 2008 housing market crash. It went up to almost 10% for a couple of years. So that is very high unemployment. We have been in very low unemployment. And even though unemployment is a little bit higher than it was, it's actually down to 4.0% this last month. So unemployment is very low. So what the Fed is looking at is they're looking at these two things. They're saying, hey, we have inflation that is still above our 2% goal, and we have unemployment, which is still below the 6% goal. They're not trying to raise unemployment necessarily, but that's kind of their like measurement of if we hit 6, we've gone too far. So the way that they fix that is they try and adjust the Fed funds rate. So the Fed fund, and here's a monthly statistic, you can kind of see, it's been hovering around this same level for a long time and slowly started ticking up, but nothing too drastic. So the Fed rate is the thing that determines all short-term lending. So the Fed is supposed to have some sort of monetary control where they're going to be able to look at the unemployment and they're going to be able to look at inflation. The theory is if the Fed funds rate goes up, less money will be spent, which will slow down inflation. It will increase the cost, which will then decrease the demand. And at the same time, if there's a decreased demand in the market should respond by increasing unemployment. So that was complicated, so I'm going to say it one more time. So the Fed, their only tool that they really have in their bag to fix inflation is they raise the Fed rate, which will then theoretically decrease spending. When spending is decreased, demand goes down, inflation will then fall, but then unemployment will rise. So the Fed has had starting in July of, or I think it was like May of 22, they started raising the Fed rate from the 0% that we had been at from 2020 onward. The reason we had a 0% rate in 2020 was because we were in a major recession, or right on the brink of going into a major recession. So the Fed said, hey, we have to do something to stimulate the economy. So we're going to drop the Fed funds rate to 0 so that people will spend more money. Then inflation started coming. They started raising the Fed funds rate pretty quickly. And then they got past the really high inflation, but they're still in this level of sticky inflation. So going back to this graph here, we are still a full percent above where the Fed wants to be, and we are trending upward. So the last couple reports have all been in that 2.9 to 3.1 range, and it's just staying really stuck there, and it's been there for about the last 4 or 5 months. Unemployment is the only thing that they're willing to give up a little bit on. Again, their goal is not to get to 6, but they're willing to go up to 6 to get there. So looking at all of that data, the Fed has basically said, hey, there's only a 30% chance this year we're going to do any sort of rate cut. They're saying, hey, unemployment is too sticky. We still have really low unemployment. So people that want jobs get jobs. People can't afford groceries because everything is too expensive. So we're going to keep the Fed funds rate where it's at for the foreseeable future. So the things that would change that would be if inflation starts to go down or if unemployment starts to go up, then the Fed would look at adjusting their rate. But projections are that this Fed rate is going to be stuck right around that same mark that it's been at for the remainder of the year and possibly a little bit longer. So how does that affect mortgage rates? We'll talk about that in a minute. Also want to talk about the stock market. So the stock market has been on a tear for the last handful of years. This is the last 6 years of what the general stock market has done. So there's a few different indexes you can look at. This is like an S&P 500 index. So we can see that over the last 6 years, the stock market has gone up about 2.5 times what it was in 2020. So obviously in 2020, there was a larger recession. We are significantly above that. And even with any sort of economic corrections we've seen, the stock market has still been rallying. And month over month, I think there's only been 1 month in the last year or two that it has consistently gone down. So that is another indicator that our economy is actually very, very strong, which is kind of something the Fed, again, doesn't want to see. The Fed wants to see a little bit of weakness so then they can begin to lower those rates. But with where everything is at, and with the amount of money in the stock market and with the gains that are going on, it again appears like the Fed is going to maintain the status quo of keeping rates where they're at. So what has caused inflation? So the big thing that caused inflation was the federal deficit spending. So this is the federal spending over the last 24 years. So the last time we had a balanced budget where the government took in more money than it spent was back in the year 2001. So that was a long time ago. Since then, we have spent more and more and more money every year. So that is not a sustainable practice, of course, but that is what our government has continued to do. So a lot of the stimulus came from 2020. The government pumped a ton of money into the economy. It looks like over $3 trillion of spending, of deficit spending. So spending money they didn't have in order to stimulate the economy. So they pumped a bunch of money in the economy. That then caused the stock market to rally, people to rehire, and inflation to kick off and go on a rampage. So all of the inflation and things like that we're seeing, a lot of that is due to the federal deficit spending and just them overspending from where they're at. So looking at individuals now outside of the federal level, the other thing that's contributing to inflation is just the amount of debt that is taking place in the American economy. So this is the trend line since 2003. So in 2003, housing debt was right around 5 trillion. Non-housing debt was around 2 trillion. Since then, it has gone up and up. Housing debt is now at $12.5 trillion, and non-housing debt, so that's going to be credit cards, car payments, student loans, and then any sort of other miscellaneous debt, which I'll break down in a second. That is at $5 trillion of debt now. So all that to say, we are also all part of the problem where as an entire economy, we are continuing to spend money on debt, which is then stimulating the economy more and giving more people jobs and causing inflation to continue going and the Fed to continue raising rates as a result of all of this deficit spending, both on the federal and on the personal level. We're getting close to the end, I promise. No one else has as many slides as me, but I got a little bit slide excited, so I'm so sorry about that. Okay, so where is this non-housing debt? So again, this is that $5 trillion line. Auto loans account for 1.6 trillion of that. Student loans count for another 1.6 trillion. Credit cards are at 1.1 trillion. And then there's a $0.5 trillion of other, some sort of consumer debt. So we can again see from 2003, these numbers have taken off and accelerated significantly. So car debt has gone up $1 trillion. Student loan debt has gone up $1.4 trillion. And this is just in the last 20 years. So again, lots and lots of extra money that doesn't necessarily exist being pumped into the economy for a very, very long time. And at some point, all of these debts are going to be, they're going to have to come due, and something is going to have to correct in the market to make up for that. So what is that going to be? A lot of people say, oh, that means the housing market's going to fall or the stock market's going to collapse. I don't know for sure. I know housing. So I'm going to talk about housing because that's the thing that I can give you a really good indication of what we've seen and where that's going. So inventory is one of the biggest measurements we want to look at on a national level. So inventory is measured by months of supply of homes. So if there are, we'll call it 300 homes on the market and 100 homes are selling every month, we have a 3-month supply. So that's just kind of how it's measured in the real estate world. Looking at 2006, 7, and 8, we begin to see many months of supply of inventory. So there were a few less buyers and a ton more houses on the market. So that eventually led to, along with just really bad lending practices, led to a large correction in the market. 2008 was specifically a housing market collapse based on bad debt that was given out. So 2008, there was a ton of houses on the market, a bunch of bad debt, all of that kind of collapsed. And since then, from 2013 onward, even 2012, we've had lower inventory. It hit its lowest numbers in 2020 and 2021, which is why the real estate market went absolutely bananas for that time. And it has since slowly recovered a little bit. So there are more houses on the market than there were a couple years ago, and things are taking a little bit longer to sell. So in Spokane, for example, the average days on market's about 40 days. In the peak of COVID, it was like 14 days. So that is a much longer time. Back in like 2006, 7, and 8, 90 to 180 days was not unheard of at all. So there was a lot more inventory from a measurement supply of buyers versus sellers in the 2008 crash. I think this is my last slide. Yep. Okay, great. So finally, what is happening with prices? My numbers got a little askewed here. But I have local and national housing prices. So looking at 2024, the average listing price was about 460. 2025 year to date is about 470. Looking at the sales price was 402 compared to 407. So we're seeing a lot of houses that are in that middle to upper price ranges not sell, just because of affordability, which I think Steven's going to talk about in just a moment. And again, it's saying median days on market is 17, but the average is actually 40. So lots more days on market, and homes that are in lower price points are selling very quickly, but the homes that are in higher price points are taking a lot longer to sell and often selling for anywhere from 5 to 10% under asking price. So that's housing. Steven, tell us about loans.
Thank you, Chase. So one of the things that I want to address first is one of the closest indexes or ways you can measure mortgage rates from an index that's available in the market, and that's called the 10-year Treasury. So you can go on to Yahoo Finance, you can Google it or just Google what the 10-year Treasury is, and that 10-year Treasury is the closest index, and I'll explain a little bit more, in the market to where mortgage rates are heading. So the reason I bring this up is because there's been a lot of talk about the federal funds rate. The federal funds rate is overnight lending. It's what banks are borrowing from each other overnight. It's very short term as set by the Federal Reserve. So the reason we don't follow the federal funds rate for tracking mortgages is that mortgages on average last for 7 to 10 years. The most popular mortgage in the United States is a 30-year fixed. However, if you look at the data, most people either refinance or sell within 7 to 10 years. So that's why we need to look at a longer term index like the 10-year Treasury. So if you look at the graph here, you can see, yes, the federal funds rate, which is the bottom, the dark blue, you can see that the overall trend does follow. But the micro movements in the market, if you look at the 10-year Treasury, which is the green line in the middle, and then you'll see the mortgage rates are orange, you can really see that as the 10-year Treasury moves, rates really do move. So I want to address this because I think it's important for, and this is for every buyer that I work with, or real estate professional that I speak with, that like when the media talks about the Fed lowered rates, they are talking about the federal funds rate, which Chase covered and really showed how the federal funds rate, was pushed down to zero during COVID. And so that federal funds rate, is impacting short-term lending. Now, rates do follow similar trends because mortgage rates, short-term rates, we're following inflation, we're following these other trends. But when you hear something in the news that the Fed cut rates, it doesn't mean that mortgage rates are going to move. And if you look at the graph, you can see significant lag times when there has been movement of the federal funds rate. Like, I know it's really small, but at the very end, if you look at the federal funds rate going down because the Fed just did their first cut, you can see that blue line going down, but you can see the mortgage rates going up. And part of that is fear of inflation. Chase mentioned that. And because the market is fearing inflation, it's more expensive for banks to borrow during periods of inflation, and that's why mortgage rates go up. So it's the reason that I bring this up is really that, yes, in general, the trend should eventually catch up. But if you look at the graph, like, you can really see the 10-year treasury. And on average, if you're like, what are mortgage rates? It's typically take the 10-year treasury, which today is at 4.53%, and add about 2 percentage points, 2 to 2.5 to that. So current 30-year fixed rates are about 7%. We'll get to a slide on that in just a minute. And the current treasury rate is 4.5. So when you see the movement in the treasury, like as the treasury gets higher, the 10-year treasury, mortgage rates get higher. So it's a direct relationship. And so here's, again, and just another, like, a simple explanation on if you go back one slide, Chase, the federal funds rate. If you put your money away for one day or you put your money away for 10 years, what is more risky? It's the 10 years, right? Because there's so many unknowns. And so the 10-year treasury right now is elevated because the Fed is uncertain about their policy. And so in that sense, there is a relationship. So Chase mentioned, that we need to see inflation come down and we need to see, unemployment. And, what can we do? I think we should all just quit our jobs and stop spending money, and rates will plummet. It's a bad idea, but honestly, that's, and people are wondering, like, why do we want this bad economic news? It's people spend money, and one thing I want to point out, Chase, if you can go back to your debt slide for this is something I want to show you guys. Not I want to see the Fed debt. If you can do the Fed debt, that would be amazing.
Yeah, it's a fun one.
Yeah, so and we'll come back to my slide in a minute on rates, but, like, is general borrowing going down? It's because we're buying our own debt, and we are, so, and I could go into that a little further, but I really want to point out to you guys 2020 and 2021. I want you to look at the amount of debt that we amassed there. The most significant portion of that debt is that we bought our own mortgage-backed securities or mortgage bonds. So let me simplify this. Let's say you have $1 million that you have lent out, okay? Picture yourselves as the lender. You have $1 million that you've lent out. You're one of these big agencies, Fannie Mae or Freddie Mac, that buy all the conventional loans. You have $1 million out. The Fed just comes in and wipes out that million and says, here, your line of credit is back. You're going to keep borrowing. You're going to keep lending money, right? Like, you have money that you've lent out and you're earning interest on it. But then the Fed comes in and rescues that and just, like, clears the loan. You're going to keep borrowing it out, right? Because you want to earn interest. You have $1 million that you can lend out, so you're going to keep borrowing it out. So this graph really shows why mortgage rates did what they have never done in history, because the Federal Reserve came in and bought all of these mortgage-backed securities or mortgage bonds, which is why we saw rates hit 2.5%, 3%. It's because we basically bought our own debt. And so when I get the question, is this going to happen again? Well, they've done it once. They actually did the purchasing of mortgage-backed securities for the very first time in 2008 after the Great Recession. They also did it again in 2012 through 2014. So, and you can see that corresponding with these higher years of debt that we've amassed. So, you know, when people ask me like, are we going to see those low rates again? I'm like, well, the Federal Reserve, our government is pretty good at picking up debt. But I don't believe, because of part of the issue that we're experiencing, as Chase mentioned, is this inflationary environment. It's very expensive, and so that's why we're seeing mortgage rates up. And so, you have to imagine like the short-term lending rates, right? So they get cheap. They've been cheap before. The Fed had the federal funds rate at zero from 2009 to 2015. So they've done this before. So COVID was its own unique like animal in the sense that the federal funds rate goes to zero, the short-term lending, again, not new. Then they also purchase the in a it was like one and a quarter to 1.5 trillion of mortgage-backed securities, which is what artificially lowered rates. So the economy, people are like, this is great. It's like all of the sudden, like getting all of this extra money in your pocket out of nowhere because borrowing costs get cheaper both in the short term. You could get an auto loan at 0% or 0.99, and you could get a mortgage at 2.5. Everybody spends, inflation goes up. So let's just look at the current predictions. I hope that's helpful with just kind of understanding the relationship there between, why it's not the short-term debt, why it's not the federal funds rate, and why we look at like the 10-year treasury, because we're looking at an index that shows money tied up for a longer period of time that matches the average duration of a mortgage. So you can kind of see like starting in 2022, that's when the Fed stopped buying a lot of our own mortgage debt and rates went up, and they also started changing the federal funds rate. So let's talk about where they're going.
So,
And
Stephen,
yeah,
so what would cause rates to go back down to 3%, let's just say? Like, what economic conditions would be needed?
a massive recession, massive.
Lots of people lose their jobs.
Lots of people lose their jobs, and
Bad.
the Fed would want to come back in and inject a ton of money into our own economy to stimulate spending and activity. So, and that's why when you look at these rate predictions, so, for the last 2 years, because I get asked this all the time, I was following one particular rate prediction. And so at the end of last year, I just decided to take 14 different or I don't even know how many are on here. It was 14 or 15, and just come up with an average because I was seeing this number dance around, and this average is based on an expectation of some of the things Chase and I touched on. Is inflation going to come down? Are we going to start a revolution and all quit our jobs and stop spending? Those sorts of things will impact rates, right? But if you look at the average of, and this is from all of these different experts that have way more degrees than me, the average is expected that we finish an average 30-year fixed conventional loan finishes at 6.375, rounded up to 6.34 at the end of 2025. And so I get updated forecasts monthly, and I really try to keep a pulse on this. This would put FHA and VA loans just under 6 because they always have a little bit better rates than conventional. So yeah, but when you look at these forecasts, there's a couple outliers that show kind of a big range that we might dip below 6. I'm not advising any of my clients that we're going to get below 6. Again, it's a tough thing for me to advise. I just kind of present the data, but that's kind of where we're supposed to go. Yeah, so that's it on rates. And as we see, back to Chase's point, which he really talked well about as far as, inflation and unemployment. you know, again, not that we want to sit and wait for bad economic news, but if you hear of a news article that like unemployment jumped, you can probably bet mortgage rates will follow.
Great. Thank you. Steven, do you have predictions on rates at the end of 2026?
6.125.
Great.
Not much lower. They will be adjusted as the economic news unfolds throughout this year.
Which the 10th is always my favorite day because that's when a lot of the news comes out. All right, Keith, tell us how this relates to taxes.
Okay, taxes. Thank you, Chase. I got one slide. Basically, I think that we're going to see a little bit of an improvement this year. Exactly what that improvement looks like, it's hard to tell. We are under the Tax Cut and Jobs Act, so let me start with that and then go back to my conclusion where I think that things will improve a little bit. 2018, we saw a very large amount of changes in the tax laws and tax regulations. Trump got elected. He passed the Tax Cut and Jobs Act. It was passed by Congress in the Senate and the House, so not via executive order, and that's important. And the idea of Tax Cut and Jobs Act was to repatriate money from foreign countries, to bring more money back into the U.S., and to make it easier for individual citizen taxpayer to save money paying less in taxes. Some of the changes are that it reduced the corporate tax rate to 21% from 35%. That's a very large jump or drop for publicly traded companies, corporations. Individual income tax rates dropped. The standard deduction increased. So everybody was getting a bigger deduction on average. The child tax credit went up to $2,000. Personal exemption went away, and that changed things dramatically for CPAs, individuals. The IRS had to revamp the W-4 form because people weren't having the right amount of withholdings taken from their paychecks because the tax rules changed. It was a significant change. For people that make a lot of money, there was this thing called the alternative minimum tax that they had to pay at least a certain amount. That went away pretty much. The state and local tax deduction went to $10,000. Reduced penalties for healthcare violations, and that made it a little bit easier for businesses to manage health insurance requirements. And the Section 179 threshold was increased. That is what allows businesses to take 100% depreciation on new purchases. So if they went out and bought some new equipment, they could write off the whole amount in year one, and that increased. So they were trying to create incentives for businesses to invest more money, spend more in the economy. Now, the reason I bring this up is because this is what we're living under right now, the Tax Cut and Jobs Act, and it's supposed to end in 2025. If it does end, then the tax rates are going to go back up, and a lot of these incentives are going to go away, and it's going to be pretty bad for people. They'll be giving more money to the IRS. It could have a potential recessionary impact. Well, the idea of the Tax Cut and Jobs Act was to improve the economy and make things easier. And Donald Trump's idea was that in the long run, it's going to bring more money back into the United States economy. In the short run, we'll have lower amounts of revenue coming in for taxes to pay for various programs. Well, some people say it worked, some people say it didn't work, but it never really actually had a chance to work because the response to COVID interrupted the long-term plan. Unemployment went way up. Money was injected into the economy. People weren't working. Businesses were closed. It was a really crazy time, as you all know. And so the impact of the Tax Cut and Jobs Act didn't really have a chance to work itself out over the course of time. So now we're sitting at a point where it's supposed to end at the end of 2025, and Trump got elected again as president, and he's passing a lot of executive orders. And it seems like there would be massive incentive for Congress to extend those favorable tax laws. If they don't, they're going to potentially, for all those folks that got elected, they're going to lose part of their base support. If the tax rates go up, if the corporate tax rates go up, if the incentives for investment go down, that's going to create the opposite effect that they wanted when they ran for their office, what they promised the people. So I think there's a large incentive for the leadership, the political leadership of our country, to extend these favorable tax laws. For all those real estate investors out there who are going to be buying an investment property, you can do what's called a cost segregation study and depreciate a large amount of your building. But if the bonus provisions go away, then you lose that incentive, you lose that ability. That's going to disincentivize purchasing real estate for investment purposes. So I don't think that's what the leadership of our country wants either. I mean, they don't want rapid inflation like you guys have already discussed, but they don't want recession. So they're always trying to figure out how to manage it, how to make it be in the middle. And it's really hard to do. And I don't think they should be doing as much as they do, but that's what's the reality of the situation is this is what they do. And then we have to pay taxes and we have to deal with that situation. So my goal is to try to mitigate the taxes and help people plan. And right now, my thought process is to have people be patient a little bit with regards to certain business decisions, because I think that the rates might stay the same or even go down. But the main concern is that if the Tax Cut and Jobs Act does end in the end of 2025 and there's no extension or provision of the cuts, then that will be negative news for a lot of people here in the United States of America. I think there's going to be a time for questions after, so I'll be available for questions, and I hope that is helpful for you guys.
Awesome. Thanks. A quick question. If these tax cuts were to be extended, when would that be? Is that a December 31st thing? Is that just whenever it hits the docket?
Well, that would be with whatever they decide. Right now, you've got laws being passed via executive order, and there's bills being proposed in Congress to be passed by the House and the Senate. They could extend it for 1 year. They could extend it for 5 years. It is open.
Cool. Awesome. Thanks, Keith.
You're welcome.
All right, Kevin, tell us about your favorite subject, insurance.
I think it's everybody's favorite subject, especially right now.
Top 5.
Yeah, so insurance has been in one of the worst markets in the last 2 years that it has ever been in. Rates have been increasing not just once or twice a year, but we've been seeing rates go up for specific carriers 3 times in the last 18 to 24 months. So we have been in the worst market pretty much ever in the insurance industry. And some of the biggest reasons why that is a lot of stuff that you guys have already been talking about and going over. Because at the most basic level, insurance is there to pay for everything that you own. And if everything that you own is getting more expensive, then the rates have to adjust to correct that. And what is happening specifically more in the state of Washington is that everything got more expensive. The cost to rebuild homes, the cost to fix vehicles, medical bills, income, everything has gone up. And as the carriers tried to um, adjust their rates to match that, the state didn't quite allow it. So if let's use Safeco as an example. Safeco filed for rate back in 2022, start of 2023, and the middle of 2023. The state didn't allow that to work itself in to everybody's policies until the end of 2023. So instead of people getting hit by a 5%, an 8%, and a 12% rate periodically over 3 years, they were all getting hit with it at the exact same time. So we were seeing rates go up by 30, 40, even 100% on people's policies in 1 year. And I'm sure some of you have seen that. And a really big part of that is because the state insurance commissioner wasn't allowing the rates necessary for the companies to be profitable. And again, specifically in Washington, we've seen just the average household home and auto annual rate go from 2,400 to 3,800, and that also kind of ties into when you're looking or the eligibility guidelines of homes specifically. So everybody has been seeing the wildfires down in California, and we've experienced a lot of those in the state of Washington as well. And that has also clearly affected the rate of especially homeowners policies. Back in 2019, 2020, the average homeowners policy was about $1,000. Now the average homeowners policy is anywhere from $1,500 to $2,000 depending on the actual coverage. And when you're going to buy a home, there's a lot of stuff that you got to think of, especially for the eligibility. And it's not just the wildfire score. There's so much more that goes into it that is going to affect your loan and the ease of purchasing your home. And so some things to help with that would be, they're pretty simple. It's just to look at the age of the roof, look at the age of the home, where the home is definitely important. And then your own claim history. So that is one of the biggest things to think about when something happens at your home, is if you should file a claim or not. We have seen incredible rate increases for one claim, and then even more for multiple claims. And especially if you have multiple claims within a five-year window, people are getting non-renewed as well. So that is extremely important to be knowledgeable of. And this is something that we advise at our agency, is that if something happens at your home and you think that you should file a claim for it, we're advising people to actually not do that. If you can cover a $5,000 loss in your home, that is going to be more profitable to you to pay that out of pocket than to file a claim on it, because you're going to lose out over the next 5 years as that claim stays on your record than if you were just to pay it out of pocket. Plus, we've seen people who filed those smaller claims in 2 years, they have a major claim, like a $50,000 water claim in their home. And now you're stuck with 2 claims in 3 years. And there's a very high risk that your policy is going to get non-renewed. Once that happens, it's extremely difficult to find homeowners insurance. The high-risk home carriers that we have access to were not prepared for the amount of business that they got in the last 2 years. So they had their guidelines set up to accept multiple claims, really high wildfire risk, and homes that are in that area. What happened was all of the primary home carriers, your Safeco, State Farms, Farmers, they all adjusted their eligibility guidelines to take in less homes, which then people had to turn to all the high-risk home carriers and start going there. We're now seeing all of those carriers are starting to tighten up their eligibility guidelines, so they're even getting harder and harder to place business with, which in turn makes it extremely difficult to find home insurance for people. So just be very, very conscious about filing claims and what that's going to do to your insurance for the next 5 years, because that's how long it lasts. Some carriers even look farther; they look 6 or 7 years in your history. Some things that you can do to combat these rate increases: the easiest and most effective thing to do is just look at your policy and see what you're paying for. So many people don't really understand what their policy is covering and how much coverage they actually have. If you bought a home in 2020 and you haven't looked at your policy since then, my guess is you are probably drastically underinsured and are paying for something that really isn't going to help you if you suffer a total loss. Primarily because the cost to rebuild has gone up by roughly 55% since 2020. So you bought a home for $250,000, you're insuring it for probably $300,000 right now, when in reality, it should be insured for $400 to $450. So look at your current policies and then adjust coverage accordingly, and then look at your deductibles. Deductibles are the biggest way and most efficient way to save money. And like I mentioned, if you're going to be filing less claims, it's better to take a higher deductible, so you're taking on more risk, but you're saving money in the long run.
Awesome. Great. Here's
What's the outlook for? I just want to ask Kevin a real quick question, Chase. What's the outlook for? Are we just gonna keep seeing, like, because right, we can have this hope that mortgage rates are gonna come down with inflation,
Right.
but I don't think that's gonna happen. What's the outlook? Do we keep seeing increases?
We see a little light at the end of the tunnel here. We've been able to speak with a few of our carriers that rates aren't going down, but eligibility guidelines are coming back to normal. So that in turn creates more competition within the market that allows people to get lower rates, because when 4 out of the top 8 carriers are just not eligible for somebody, they're stuck with the 4 carriers that are probably higher. So we are seeing some light at the end of the tunnel, in that carriers are taking less rate this year than they have in the past 2 years. So we will still see rates go up, but you're not going to see your 30% increases. You'll see your 5 to 10% increases.
Interesting. Okay. Cool. Thank you. We have 7 minutes. If anyone has any questions, anything that wasn't covered, do you like covered, or?
I have a question.
Mhm.
Since we should pay more out of pocket for a deductible, or should we just raise the deductible on our policies to lower the premiums if we're going to pay that anyway and not make claims unless they're huge?
That's what we've been advising people, because a lot of people used to have $500 or $1,000 deductibles, and sometimes it still makes sense. Sometimes the difference between the $1,000 deductible and, let's say, $2,000 deductible wouldn't make sense in the long run. But we've been seeing the difference between $1,000 deductible and that $2,000 deductible be significant enough where in the long run you're going to make that back, ideally before you make a claim. And where we see the biggest increase or savings would be let's say you go from a $1,000 deductible to a $5,000 deductible. That's going to save a considerable amount of money. And like I mentioned, if you're filing a claim under $5,000, you're probably going to lose out in the long run anyways.
Part of the problem with insurance is that the state of Washington does not allow carriers to pass on the cost of reinsurance. Until legislation is passed to change this, carriers will be reluctant to open up. Also, carriers are viewing parts of Spokane County as wildfire hazard. Yeah, I've gotten the wildfire question a lot. Kevin, do you have any thoughts on that?
Yeah, I mean, I think the biggest example of this was down in California, where the carriers were filing for rate increases and were telling the state that they needed to do certain things in those areas in order for them to insure it. But what it came down to was that the state they weren't allowing them to take the necessary rate in those areas to be profitable, and then the state wasn't fixing those wildfire areas. So that forced the carriers to evacuate the state, and then forces people to go on the FAIR plan, which is not great. That is drastically underinsured. There's not enough money in it to pay all those claims that has happened. Plus, it is not really good. It's really bad insurance for your home too. It's probably your last resort.
Interesting. Also, any other questions? I just put all of our information in the chat. So if you'd love to buy or sell a house, I'd love to chat with you. Stephen would also love to chat with you. If you need CPA, Keith is available, and Kevin's available if you want to have him take a look at your insurance. So quick shameless plug there. But any other questions? Wonderful. We're going to end 3 minutes early. Well, thank you all again for coming. If y'all need anything, feel free to reach out anytime. Thanks, guys.
Wait, Mitch had a